These banks are scamming you. They want you to live paycheck to paycheck without knowing where your money goes. Several books backed it. They've been hiding crucial truths for years. And with the rise of cryptocurrencies, more and more people are waking up to what's really going on behind the scenes. In this video, I'll share 5 truths that banks don't want you to know, and understanding these facts could change your life. Let's start with the hard truth about your savings. Keeping your money in a bank isn't as smart as you think it is. Seriously, when was the last time you checked the interest rate on your savings account? And even if you did check it recently, the interest rate on that thing is probably like, less than 0.5% for the top banks like Citibank. Although some banks do offer a bit more, but even still, the interest rate on that thing is under 1%. And to be honest, with the inflation rate sitting at not so measly 4.58% in the US, your money is actually losing instead of gaining value over time. So what's the point of depositing your cash in the bank if it's just going to lose its value? You're essentially losing money every year, especially when the price of things like homes and stocks are rising. Not only that, but the minor things like food, water, clothes, basically anything that you use your money to buy, their prices are just gonna keep going up. So let's be real, banks are not the ones where you make money. They're a place to put it temporarily. But if you want your money to grow, you'll have to look beyond the traditional savings account. It's shocking, but every bank in the world has the ability to create money. And no, I'm not talking about magic, pulling money out of thin air and all that. I'm actually talking about fractional reserve banking. It's when you deposit money in the bank, let's say $1,000. Well, the truth is, the bank doesn't just hold on to it. They actually spend it. They use your deposit to make loans to other people. That's how they're able to pay you a tiny amount of interest rates while lending out your money at much higher interest rates. Here's how it works. Let's assume that the reserve requirement is 10%, so they keep that $100 and then lend that $900 to someone else. Now that $900 ends up getting spent and deposited to another bank, and that bank keeps $90 in reserve and lends out $810. And this repeats. Over time, the loans and credit increase potentially around $10,000 from the original $1,000. Now, of course, you won't be having $10,000 overnight, but that's how they get to use a lot more money than you think. But wait, I'm still confused. How does borrowing money actually make you money? It doesn't make sense, right? Well, let's take a look at a famous example, Mark Zuckerberg. In 2012, Zuckerberg bought a $5.95 million home in Palo Alto with a 30-year mortgage, despite already having billions in net worth. Why take on a mortgage when he could pay for it right then and there? The answer? Free money. The interest rates were incredibly low, just around 1%. Inflation, on the other hand, was around 2.5%. So essentially, borrowing money at an interest rate lower than inflation meant Zuckerberg was paying less in real value than he borrowed. Meanwhile, he could invest his own capital elsewhere and earn a return far higher than the 1% he was paying. That's how the rich leverage debt to generate more wealth. For example, if you borrow $1 million at 1% interest and then invest that in a project that generates 10% returns, you're essentially making $100,000 annually while only paying $10,000 in interest. So even though you owe money, you're using that borrowed money to make even more money. Does that make sense? Another point that you have to understand, the more money that you have, the better terms you get from the bank. Think about it, if you're worth millions or even billions of money, then the bank tells itself, hey, we can give this person cash because if we let them borrow it, they can pay the loan, whether in cash or in assets. They know you're a safe bet. You're not going to default on a loan, and even if you do, you have assets to sell in order to repay them. So the risk for the bank is low. In fact, banks have been doing this for centuries. They've always preferred lending to people who have assets that generate income, whether it's land or a successful business. But if you're just an average Joe trying to get a loan, they'll tell themselves, This person might not be able to pay and will lose money if we give them money, so it's better that we don't lend him money. Or if we do, let's give them a high interest rate so that we can somehow relieve that risk. See, the bank sees you as a higher risk because they think you can't pay back the loan. You might lose your job, get sick, or face some problems financially. That's why they'll charge you higher interest rates. So here's the key takeaway. The richer you are, the easier it is to get loans and the better the terms are. But the average person will have to work their way up. So if you want better interest rates, lower mortgage rates, and favorable loan terms, you've got to start by improving your financial situation. Build assets, develop a strong credit history, and make sure you're in the best possible position to negotiate. Let's talk about the real powerhouse of banks, credit cards. Did you know that about 70% of Americans with credit card debt admit that they can't pay it off in a year? And that's a scary statistic. But why is it so bad? Well, because credit cards charge some of the highest interest rates in the industry, often over 20%. And when you're paying that kind of interest, your debt grows much faster than you can pay it off. Banks know this, and that's why they're constantly offering you new credit cards, even if you don't need them. It's not out of the kindness of their hearts, but they know that you're likely to carry a balance. And as long as you're in debt, they're making a huge profit off of it. The worst part, if you can't pay off your credit card debt, the interest will just keep stacking up. And before you know it, your debt is out of control. And this is a trap that many people fall into. Using credit cards responsibly is one thing. It can even help you by building your credit score and offering rewards. But, and this is a big but, if you're not financially disciplined, you're just handing money over to the bank in the form of interest payments. So the bottom line here is clear. Don't get sucked into this trap. If you can't pay off your balance every month, you're better off using other financial tools. Now, let's talk about the future. In case you don't know, cryptocurrencies like Bitcoin, Ethereum, and others are currently shaking the financial world. They're based on blockchain technology, which means that no central authority like a bank controls the flow of money. Instead, transactions are checked and recorded on a file that anyone can access. Cryptocurrencies have the potential to democratize banking. Instead of relying on banks to create money, cryptocurrencies allow individuals to directly control their money. For example, you can use crypto to transfer money across borders directly without paying any sizable fees to banks, or even a return from your crypto investments by staking or lending your tokens. But let's be clear, currently cryptocurrency is very dangerous. As of the moment, it's not the perfect solution to all the problems the banking system gave us. It's better to think that it offers an alternative way to think about money. And the more people start using crypto, we may see the traditional banking system change to adapt to it. In fact, banking has already been democratized a lot because we now have access to financial services from our phones that we bring wherever we are. The days of having to walk into a bank branch just to manage your money are over. But admittedly, there's still a lot of room for improvement, and crypto could be the next big step in that evolution. At the end of the day, the rich aren't smarter than you. They just think differently when it comes to money. They understand how to leverage the banking system, take advantage of low interest rates, and how to use credit wisely. They also understand that borrowing money, when done correctly, can lead to more money. It's time to start thinking like them. Let's stop looking at debt as a burden. Look at it more as a tool that you can use to earn more money. Whether it's through investments, real estate, or even starting your own business, the key is to understand the rules of the game and use them to your advantage. The banks may be playing the game to their advantage, but you can too. With the right knowledge and mindset, you can make money work for you too, not the other way around. Now, if you like this video, make sure to subscribe to get more videos like this. And if you want more content, click here to learn how I earn $100,000 a month.